In this video, I have the key to trend following trading for you. I will share with you why so many traders struggle with trend following trading and how to fix that, and exactly what to look for when you're looking for trend following trading. So when we look at a chart, those big moves where the market just goes down vertically or shoots up in a straight line, that really stands out obviously, and those are the moves where traders want to trade, and rightfully so, because that's where you make the most money in the shortest amount of time. However, what ends up happening most of the time is that traders end up chasing those moves, and they're always in a reactive mindset instead of being able to anticipate what may happen. So when it comes to trends and understanding trends in trading, we distinguish between the so-called trending or impulsive periods and the corrective periods. And this is absolutely key because that's the underlying rhythm that every trend will unfold in. So what happens is that we want to trade the trending and the impulsive phases because that's where the market moves the most. And we want to avoid the corrective phases because that's where the market is trading sideways, and there's obviously not much money to be made because the market is generally just bouncing up and down in different ways. However, what is really important to understand is that the key is really the transition where the market goes from corrective into impulsive and from corrective into impulsive in the opposite way, because this is really where most traders will find their edge in trading. This is very important because that way you are able to avoid trading within a corrective wave, and you are able to get in on a new trending and impulsive wave very early on. So what I would recommend is that if you are a trend following trader, focus on learning corrective waves and really study them. And in this video, I have a few different ways and a few different examples of how corrective waves can manifest, because there are many different ways of how obviously this trending and corrective interplay will manifest on your charts. So it's not always going to look in exactly that same way. We're going to see that in this video. And in your trading, you will find it as well. I'm not able to cover every variation of trending and corrective wave that we ever going to encounter. But I would really recommend that you start looking at trends and looking at trend following trading in a new light, and really understand that those transitions where you go from one phase, from the corrective into the trending phase, that's really where it's important to look for trading ideas, because you'll be able to get in on a new trend very early on. Generally, you will also be able to get a very tight stop loss, which will help you boost your reward to risk ratio, which means that your winning trades will be much larger than your losing trades. So in this video, what we're going to do is we're going to really focus on understanding corrective wave behavior and the transition. So I've prepared a few examples that will help you understand what we are after. So we're starting with one of the most classic examples, a sideways corrective wave. Some traders may refer to it as a sideways consolidation. And what happens is that after a trending and impulsive wave, the market puts in a top. This is the end of this impulsive wave. And then the market has struggled to get above this area. And in trading, we call this then a resistance area where the market keeps bouncing lower from. And that is then where we have our corrective wave. Very important to understand is that we need to have the impulsive wave that leads into the corrective wave. So we need to see that previously, prior to the corrective wave, the market has been trending, and we need to establish that because that shows us that we are in a long market, which means that the market has been going higher in the past, and as traders, we can only know what has happened on our charts in the past, and we need to use that for our future predictions, so to speak. So that's all we have as traders. However, there are some very important clues that will help us distinguish between understanding and judging those transitions. Is this a good transition that we're looking at, or is it a mediocre or maybe not even a good transition? So what we have here is, first of all, a very well-defined sideways range. We have the resistance at the top. We have the support at the bottom. You can see here, this is the end of the previous trending wave. Then we use the resistance, turns into support, multiple supports. By the way, one very important thing is that not always will you be able to identify or trade a corrective wave transition. The market will unfold in a million different ways. And the good thing is that there will always be another trade, there will always be another corrective wave that you will be able to anticipate and read much better. So sometimes when you're not able to make sense of a corrective wave and you're just not able to use your technical analysis skills and the principles that you've learned, so be it, just wait for the next one. The key to this transition period is what I've referred to in the past as a lower bounce or a breakout buildup. So when we look at how the market trades into this resistance level, you can see the market sells off very strongly here. We come close to it, sell off back to the lows. We come here into this level, and this time it's different. Why is that different? Because this time the market is not able to get lower at all, you can see. Whereas previously the market sold off to here, now we're only able to get to here, the next time here, and then this time when the market bounced into the resistance level, we only have one red candle before we then break out and get above this area. So this is what we call a lower bounce. Every time the market moves into the area, we bounce away lower. And some traders may refer to it as a breakout buildup. And this shows us that there's a lot of bullish pressure building. Why? Because previously the sellers, every time the market reached into the area, were moving in and sold the price lower. But this changed and this didn't happen anymore, which shows us that we have a lot more buyers now and way fewer sellers. So this puts the ball and the odds a little bit more on the bullish side. And also we are in a bullish market overall anyway, so we need to find those clues for what makes a bullish breakout more likely. However, the key is that we are always waiting for the market to really clear such a corrective wave. I would not recommend to trade in a corrective wave. That's a very good rule to stick by. Never trade as long as the market is stuck in a correction, because the market can bounce either way. The market is unpredictable in those ranges. Wait for the market to clear those ranges, and that's where you then find the good trading opportunities. The good thing, as I said in the beginning, you will generally be able to get in a very decent entry with a very tight stop loss. Stop loss placement is very personal. Some traders are very aggressive. They may put it just underneath the area. Some traders may be a little bit more risk averse and use a wider stop loss underneath one of the highs or use another criteria. It's a little bit up to you. I mentioned in the past that the closer your stop loss, the more easy it is for the price to hit it, which means that your win rate will suffer a little bit, but also the trade-off is that the closer your stop loss is, the higher your reward to risk ratio, right? So that's something to consider as well. Off to the next consolidation. Here we have a liquidity or stop run. And the key is, first of all, again, clearly we have a prior impulsive wave. We put in here our highest point, and that is then our reference point going forward. We want to make sure that the market is trading above those areas. And what we see afterwards is a sell-off attempt. Here you can see that, totally fine. We're not looking for shorts in this market anyway. Then you can see what is really interesting. The market tried to break below that. However, it got rejected. This tells us already one thing, that we have a lot of bullish pressure here probably, and the bears are not super strong here. Then what we see afterwards, the market makes it all the way back to the resistance area here, is moving lower, but not much this time, right? Whereas previously we moved lower quite a bit. This time we have a lower bounce concept or component. Then we have our breakout area or breakout candle rather, which is good. You can see a strong breakout candle, that's preferred. Then we pull away a little bit, and this is here our liquidity run. And this is up to you. How do you want to trade those corrective transitions? Are you a breakout trader, or do you want to be a breakout trader? Or are you waiting for a pullback into those areas? And it's very, very common to see those pullbacks. And that is where the pullback is going for the stops, because everybody who went long here, will have their stop loss probably somewhere here in this range, somewhere, maybe a little bit lower as well, but the bulk of the stops will be somewhere in here. The market goes for the stops, and then, let me clear it a little bit. The next candle is a very, very strong breakout candle, right? You can see it's almost an engulfing candle, and that is the key. After the market dips into the stop zone, you really want to see and you want to wait definitely for the strong bullish candle. That shows you that the momentum is reversing. Typically, you not necessarily have to wait here for the market to make a completely higher high and break out into new highs. Some traders may do that, totally up to you, but the stop and liquidity run concept is usually confirmed either with the first green candle or the second green candle. Generally, you just want to see a very strong momentum push and momentum reversal after the market tried to dip back into the corrective wave and is then rejected higher. So another very, very interesting concept. And the liquidity run can be really combined with most other corrective transitioning trading strategies. Most of the time we are looking for a breakout, and you can then also choose to trade and wait for a pullback. Obviously, not always will there be a pullback, so that's something to consider as well. Let's take a look at this one, and here we have a very complex and interesting trade study. So we have an inverse head and shoulders here, First of all, obviously, you can see clearly we're in a bullish phase. The market is definitely bullish. The bullish impulsive waves are much stronger and longer than the corrective waves that follow. So that gives us the idea and the confirmation that we only want to look for longs here, as long as this is the case and the principle of the bullish trend has not been violated. However, another thing that really helps, and I mentioned it so many times, is the pivot point. Activate the daily pivot point. In indicator, you just search for pivot. It's called pivot point standard. You apply it, you go to settings. I only use the P here. I turn off S and R levels, make it a little bit thicker. Pivot time frame, you can choose the daily time frame, and then you have your daily central pivot point. And what you can see here is, first of all, a few things that you can gather from the pivot. First of all, you want to make sure if you are in a bullish market, the price should generally be above the central pivot point, which is the key here. We never challenge the pivot point. However, one thing that is really interesting here, the right shoulder here is testing the pivot point here, right? We move into the pivot point, we try to get below it, and we are reversed and rejected. This is a very, very bullish signal when you see a pivot point rejection, especially in the right trend context, because at this point we already know we are in a bullish trend. We want to look for longs. We are here in this corrective inverse head and shoulder pattern, and then we have our pivot point rejection. And you can already see how you can start building very interesting trading strategies around that. You just find enough confluence factors that make sense together, and then you can start building a checklist for your trading. So you want to have the right pivot structure. You want to find maybe a rejection or a pullback into the pivot. You want to find a good corrective, whatever you're looking for in a pivot, in a corrective wave. And that is then how you can find your edge. You can also have a filter that says, I only want to trade very strong breakout candles. So you avoid breakouts where the price is just crawling over a level. And you have a filter for just trade large breakout candles. And in this case, you can see we break out, come back into the resistance level, retest it as support. This time we don't have a deep liquidity run, and then afterwards we continue higher. One of my favorite corrective phases is the so-called flag, and for a flag we use a trend line, and the trend line is moving against the ongoing trend direction. So we are clearly here in a downtrend, right? We have a very strong impulsive move, a little bit of a correction, small continuation, and then we move into this flag pattern. And there are so many things that are quite interesting about this. First of all, we can compare the angle of the impulsive wave, which is very steep. So this means in a short amount of time, the market sold off quite a lot, which means we have a lot of sellers. And here, over a pretty long amount of time, the market didn't move much higher, right? So the corrective wave shows us a lot of weakness, not a lot of bullishness. Also, we have this, which is really interesting. We have a fake out. The market is trying to show a lot of bullishness, and there was a period of short bullishness. Maybe there was a news item that could have acted as a catalyst, but the key is that we are falling back into the flag, and afterwards we're not able to get above this previous high. We're back at the trend line here, and then we have our corrective transition breakout. So flags are really great, and you will often be able to use trend lines to define those corrective waves. So what you really want to find is a corrective wave that doesn't have a very steep angle here on the trend line. The steeper the angle, obviously the more bullishness it would show. The slower the angle or the lower the angle, the less steep, it means the less bullishness you have. That shows you that the overall trend, in this case the bearish trend, is still intact and in play. So I want to leave it at that. There are many different ways of corrective waves. They can manifest in so many different ways. If you're interested, leave a comment below, and I may consider making part 2 where we take a look at more corrective waves and find out different ways of how to trade the transitions. Let me know what you think, and I look forward to hearing from you.